Welcome back to Financial Independence 101, your place to go to get motivated and excited to make money, save money, invest money, and become financially independent just like me. My name is Mike, and today I want to talk to you about abnormally low interest rates and the negative impact that they have on everybody, on the economy, on personal savings, in every aspect of negative rates, low rates, all that great stuff coming up. So I predominantly invest in fixed income investments. Last year, because they were lowering interest rates so fast, I actually made like 50 grand in appreciation. I actually haven't realized that yet, but that's just the appreciation on one of my accounts because of fixed income investments. But when you look at this chart here and you start to wonder, why are they doing this? Why are they lowering rates like this? You can see that there is a reason they haven't gotten back to nominal rates of 4.5% to 5%. And they even started throwing out terms like the new nominal. And there's very specific reasons why they didn't go back to nominal rates. But so in order for us to do that, we're going to talk about high interest rates before we talk about low interest rates. But when you look at this chart here, from about 2008 to 2017, the better part of a decade, they kept rates at about 0.25%, or vastly lower than they should have been. Generally, when you look at this chart, you look at other recessionary timeframes where they went down not that low, and then they started raising them back up to cool the economy off. So if we've had the strongest economy ever, is it just because they've kept this artificial number, this artificial interest rate in place for an abnormally long amount of time? That may be part of it. Want to look at a couple of reasons we have higher interest rates, some of the effects of higher interest rates. Well, it increases the cost of borrowing to people. If you have higher interest rates, it's kind of basic. Improved return for savers. To me, I think as a fixed income investor, I just think that that is something that people that have worked for 30, 40 years have counted on, having some sort of safe place to park their money. And that's gone now. We're going to get into that. That's one of my 5 points, but I'm going to dig narrow and deep on that. Higher interest rates for house payments, so it cools off the economy. Higher rates cool off the economy. Banks may be more willing to lend at high interest rates, less willing to lend where we are right now. Have you heard about the repo market? This also could reduce the confidence in borrowers. The overall macro impact here would be currency will appreciate, making exports less competitive and exports cheaper. Inflation will tend to be lower. Economic growth will tend to be slower. Unemployment could rise. And then government will see rising borrowing costs. That is key to this. So this is the number one reason why the government is keeping, well, Federal Reserve, not really the government. Federal Reserve is keeping interest rates low. They won't go back to nominal. They won't go back to 5% because we can't, as a country, afford it. We're flat out broke. I mean, look at this. If you look at this national debt clock, and you look at the numbers I'm about to go into and show you, we're broke. If any household operated like the U.S. government, they'd have been in bankruptcy decades ago. Which, by the way, is not a good thing. Okay, so let's look at this $23.255 trillion. Multiply it by 0.05, and that equals $1.17 trillion. So if we had a 5% interest rate, servicing the debt would cost us $1.17 trillion. Now, if we have 1.5% interest rate, like right now it's about 1.75, that would only be 0.35 trillion. So are you seeing why the rates are so low? Rates are low to save money. It's all about the dollars. And the thing is, they're not concerned about rampant inflation. They're not concerned about all the negatives that we're going to see with lower interest rates. So here's a chart straight from the Federal Reserve itself, showing how much that we actually brought in as a U.S. government. And it's, if you see down there, FY19 actual was 3.46 trillion. And we spent, when I say we, I say we, I didn't spend it, but 4.4 1.47 trillion. So almost $1 trillion deficit last year, which, by the way, I'm sure that we spent way more money than that. That's just what they're letting us know that they spent. This doesn't take into account all the promises that they made, the promissory spending, which they call unfunded liabilities. This doesn't include a lot of that stuff. This is just what they show us. But hey, at least they're admitting that we're not balancing this. Well, my question is, if you had 5% interest rates and $1.17 trillion, what percentage of that is compared to what we're bringing in? We're bringing in 3.462 trillion, and 1.17 trillion would be about a third, versus 0.35 trillion is 10%, a tenth. That's why rates are low. So let's talk about what low rates really do, how they negatively impact everything. A lot of things. They shouldn't stay low forever. I'm saying staying low for an abnormally long amount of time, such as a decade, is going to cause some problems. So first thing it's going to do, it's going to kill savers. So a lot of people that are saving money and they put money into their bank account or whatever, they don't want to get a 0.1% interest rate. So they're going to chase, savers are going to chase some sort of rate, right? So when you save your money and say, let's go buy a CD. I loaded up on 3.3% CDs last year, which are now worth $50,000 more than what I paid for them. In fact, less than a year, they went up to that. And they're probably going to go, by the time they lower rates again, it's probably going to be worth over $100,000 more, simply because of the rate. People are chasing that rate. And I'm glad I did it. That's all I gotta say. I'm glad I did it. I did my flight to safety early, and it's paying off. And now with them lowering rates like this, where are people gonna park their money now that they're not getting anything out of it? And in fact, you really can't buy the CDs as new issues like I did last year anymore, because the new issues are now callable. What does callable mean? Callable means that even if you've got a CD for 10 years, if rates go lower, those banks can just take that money back from you, give you your money back, take their CD back, and then you're stuck making 0.01% on your money. But even scarier than that, maybe some of these savers that can't afford to take a loss put the money in the stock market and write it down 50%. That would be even scarier. That would definitely kill savers. So another negative is lower rates encourage more debt, encourage more on all levels. See, the fact that it's cheaper to borrow money now than it should be costing 5, maybe 6% to borrow money. It shouldn't be costing 1.25%. That's not cool. That's not good. We're just getting deeper and deeper into debt. And if you watch my channel, you know that I am anti-debt. I do not like debt. I do not leverage. Yeah, there's a lot of people that become billionaires with leverage. There are 1,000 times more people that lose their butt because over leverage than the people that become billionaires. Trust me. Well, you don't have to trust me. You can look it up. But anyway, with this, more people are going into debt because of cheap money. And it just keeps happening that way. And it continues to happen. And it's scary. What's this number going to look like in a decade? 50 trillion? The next big problem with low rates is the fact that we're going to see rampant inflation. And I'm really concerned about this. Now, the government tries to say that, well, we have 1.8, 1.9% inflation. We're slightly under 2% inflation. But see, they don't look at every number. They don't look at everything. They don't look at the majority of what I spend my money on. Food. I do think they do a lot to keep the food prices down with the subsidies, so I am going to give them that. But the reality of this is, when I go out and shop, what I was paying for prices last year and the year before, well, they're far higher than 1.9% higher, and I can guarantee you that. And if you've bought anything at the store this year, and then you bought stuff at the store last year and the year before, then you can attest to the same thing. Oh wait, unless you're talking about a 75-inch TV, because now I remember when a 75-inch TV was $30,000, and now you can get a 75-inch TV for around $1,000. So okay. I guess you're right. I guess we don't have inflation. No, that's just technology, and that's just the way things work in the technology world. There's still a TV out there they'll charge you $30,000 for, trust me. The next thing, low interest rates encourages risky investment. And I have to tell you, when you can't get your 3% anymore, now you struggle to get 2%, even in long-term CDs, and then you say, okay, well, I'll just sit in it at 0.1%. After a while, you got to understand, you got to do something with that money, and it encourages this risky investment. And I don't think there's anything riskier than the stock market right now at the highs. If you really look at the way the stock market is operating right now, fundamentals aren't driving it higher. Fundamentals aren't driving it lower. It's getting driven higher by all other means, but low interest rates are part of it. But you know what? The interest rates have been so low for so long that now if they raise it, the market will correct. Well, that's the whole point of a correction, is to get it to the correct price. It is overvalued. There's a lot of companies within this market that are overvalued, that have no business being at the valuation that they are. That's not what this video is all about, but I can tell you right now that a retiree that only has $100,000, putting it in the stock market, turning it into 50 or 40 over the next few years is not wise, in my opinion. Last point I want to make about negatives of low interest rates is the fact that we lose the main tool that the Fed uses to battle a recession, to battle a financial crisis: lowering interest rates. Generally, when you lower interest rates during a crisis situation, then you free up lending and you get ourselves out of this problem. We generally stimulate the economy. So if we continue on this downward cycle right now, keeping rates low, if we see a financial crisis tomorrow, that little 1.75% drop isn't going to help us nearly as much as, say, 5% drop. The thing is, we've already taken the medicine before we get sick. What's going to happen when we truly get sick and we've run out of medicine? So the answer is negative interest rates, and let me tell you, negative interest rates aren't the solution, but let me tell you what would happen if we go to negative interest rates. First thing is, there would be no more savings in the U.S. Like, you already think there's not very much savings in the U.S., there'd be no savings in the U.S. The next thing would be that the only buyers of these negative rate bonds would be people thinking that we're having an even worse doomsday scenario coming. Like, the only investors that would invest in negative rates are people that are thinking that everywhere else they'd lose 20, 30, 40, 50%. That is not a good outcome. Negative rates are not good, by the way. It would stress the financial system, which already is struggling right now, every day. And then once you cross into negative interest rates, how are you ever going to go back to positive again? Like, we're already struggling to get back to 5%, so how would we even go to positive? It would be something that we couldn't come back from. And if we did come back from it, it would be financially and economically catastrophic. And the biggest shift you'd see is increased cash hoarding. You would have people back to stuffing cash in the mattress if we ever saw negative rates. If you knew leaving your money in the bank, you would lose 0.1 or 0.2%, or in Switzerland, negative. If you knew you'd lose money like that, you definitely would not keep it in a bank. I know I wouldn't. So I hope I was able to shine a light on some of the negatives of, well, low interest rates, and definitely the negatives of negative interest rates, because there's zero positive outcome of negative interest rates, and we should never see that in the US, I would hope. Like, subscribe. Financial Independence 101 out.